Hey everyone, and welcome to Momentum channel. My name is Mo, and in this video, as part of our Blossom portfolio review series, we have a few other portfolios that we would like to review. Let's get into it. These are the folks that had shown some interest to have their portfolios reviewed. Well, then we start with Dan. He was one of the folks that commented. Thanks, Dan, for this opportunity. I think your portfolio is somewhat easy for us to review. You only have 3 holdings right now in your portfolio. I can see you have shares of 𝗋𝐋𝐈𝐖, which is one ETF considered an all-in-one ETF. It gives you exposure and diversification throughout the market, including the US, Canada, international emerging markets. Definitely one of my favorite holdings. I don't have 𝗋𝐋𝐈𝐖 in my portfolio, but I do have 𝗖𝐋𝐈𝐖, which is similar concept, but offered by Vanguard. Currently, about more than half of your exposure is to 𝗋𝐋𝐈𝐼. Excellent choice. You are upping your exposure to US market by investing in ex-US, which is actually investing in the S&P 500 in the US, and it's offered by BlackRock. Wonderful holding as well. You're increasing your exposure to US market through that. To be honest with you, there's nothing that I can really comment against this portfolio. It's a very simple portfolio, yet practical, gives you exposure internationally, more exposure to US, and as well, you have some exposure to Canadian markets through 𝗋𝐋𝐈𝐼. Beautiful. You do also have around 5% exposure to the Horizon's high interest savings ETF. I believe this is where you're parking some of your cash on the side and redeploying that fund at the suitable time back into the market when the opportunity presents itself. All in all, simple yet beautiful approach to investing. As you even add to your portfolio, you are approaching index investing. And that, my friend, deserves a follow. Next, we are going to move on and take a look at our second person who I had on my list to actually review their portfolio. It was actually Christy. So let me see if Christy is here. Thanks, Christy, for the opportunity. Your portfolio is slightly more expanded. You have multiple different holdings. When I look at it at first glance, I do see a variety of different holdings, including some of the top holdings for you include Vanguard S&P 500, the index ETF. It's similar to ex-US that Dan had, but you have the Vanguard version of it, VFV. It is also one of my large holdings too, and I think it's an excellent choice for investors wanting to get exposure to the US stock market. You also have another all-in-one ETF. Instead of 𝗋𝐋𝐈𝐼 that Dan had, you had a Vanguard version of it, but you have VGRO, Vanguard Growth Portfolio. The difference between VGRO and 𝗖𝐋𝐈𝐼 or 𝗋𝐋𝐈𝐼 is that with VGRO, you're getting about 80% exposure to stocks. The other 20% is exposure to fixed income and bonds. Whereas with 𝗖𝐋𝐈𝐼 or 𝗋𝐋𝐈𝐼, you're getting 100% exposure to stocks or equities. I think it's a good holding. Particularly, I think the difference between VGRO and 𝗖𝐋𝐈𝐼 is really depends on how much exposure you want to get to stocks. For me personally, I think that if you are younger and you have a longer time horizon, it may be more worthwhile to pursue investing in 𝗖𝐋𝐈𝐼 or 𝗋𝐋𝐈𝐼 instead of VGRO or XGRO, because you're getting more exposure to stocks, and usually with more of that risk comes a little bit more rewards longer term. But at the same time, this is not a bad holding to have exposure to as well. It really depends on your consideration and other pieces. I'm going to go back quickly as well. Hover over. I see that Christy, I think you are also a pro member, so easily we can take a quick look at our sector breakdown side by side. It seems like you are also very much nicely diversified. Your biggest holdings and exposure by market sector are to financials at 20%. Following that, you have exposure to energy sector at about 18%, and then technology at 12%. Interesting enough, those are also my top 3 holdings from a market exposure perspective. I don't see any red flag in there. Let me quickly open up as well and list your holdings by their overall return. You do see you have a few holdings that are showing quite positive. And one thing that stood out for me before I make this video, I actually dove into your portfolio a tad bit just to prepare for recording this one. I did notice that some of your good performing, top 3 performing, actually 2 of them are index ETFs, VFE and VGRO. And they're already among the top 3. Your TD Bank is also doing quite good. And if I look at the ones that are not doing quite well in terms of the performance, you have quite a bit of them, that are in negative territory. Some even double digits, such as Canadian Utilities, TELUS, and B2 Gold Corporation. Overall, you have quite a number of different holdings in your portfolio. It is fine as long as I would say, you have the time to research these companies, particularly because I do notice that only a few of your holdings seems to be ETF. The rest of them are actually individual stocks. As long as you have time to kind of do your due diligence, look into these funds, perhaps take the time to listen to their conference calls, earnings calls, follow the company news, I think that should be fine. Or perhaps maybe you have some more experience with these companies because you're a customer of them, or you have more insight, more information around these businesses. But otherwise, my 2 cents is, it's always not a bad idea if you try to limit your number of holdings to a smaller kind of count. It gives you a little bit of that breathing room. You don't have to worry about so many different holdings that they can go in different directions. For me, I find it when I see some of my holdings in my portfolio in negative territory, especially if they're hitting that double-digit negative, even though I know that as an investor, you shouldn't worry about it all the time, or something, especially if you're a long-term investor, it does still has a little of that negative burden and negative kind of connotations for me. I prefer, as a result of that, to try to limit the number of holdings, because with less number of holdings and a little bit of that diversification through index investing, that makes me at least kind of pass that sleep at night test. I can sleep at night more comfortably knowing that my money is diversified through index funds. But it is honestly a little bit of that personal preference as well. So I don't want to necessarily dictate anything whatsoever. It's just my observation and my personal opinion. So thank you for doing that, Christy, and for giving us the opportunity to review your portfolio. I appreciate that. And the last portfolio to review as part of this episode is Joel Rogers. Looking at today's return and all-time return. Joel, I'm looking at it, and from your portfolio, you do mention that you're hoping to retire in the next 20 years. That's so exciting. I do see your all-time return is positive 14% plus, and I did notice as well some of your returns on VFE, VGRO, and whatnot. Something kind of indirectly suggests to me that you've probably been investing in the market for a while now. For example, I'm looking at your VFE returns, 26.5%. Just a massive return. Suggests to me that you've probably been investing in the market definitely more than 1 year. Do let me know in the comment section below. I have a feeling that you've actually been investing for quite some time. But nonetheless, great all-time returns. It's just amazing. It's wonderful how to see your biggest holding in terms of biggest return, at least most positive return, is one of your holdings that is actually one of your smallest holding, in fact, is the ZLB, or BMO, low volatility Canadian equity. So well done there overall. If I redo this based on total value, your biggest exposures by investments are to VGRO, VFV, ZEB. These are your top 3 holdings. One thing that stood out for me, Joel, is that you have both VGRO and V equity. I find it a little bit kind of a redundancy, or the word that I'm probably looking for is maybe a moment for reconsideration. With VGRO, as I alluded to earlier on, you're getting exposures at 80% stock, 20% fixed income or bonds. And with V equity, you're getting 100% exposure to equities. I would say, depending on your considerations, such as your age, your risk tolerance, and whatnot, you usually want to go with one of them. I don't personally see why you would want to keep both of these ETFs. Just my observation and 2 cents there. I do notice that you have shares of ZEB, which gives you exposure to the financial sector. That's quite interesting. You do have, however, shares of VDY, which we know with VDY, close to 55 to 60% of exposure of VDY, which consists of mainly Canadian dividend-paying stocks, is to financial sector. And I believe VDY has all of the top 6 banks in it. It might be a little bit of that redundancy again, given that you have VDY, you might want to consider to maybe get out of the ZEB, unless the consideration is that you want to even increase your exposure to the Canadian max beyond what you're getting to the VDY. The other point that I noticed is that you have shares of XEC. In fact, it's one of my own holdings, and through XEC, you try to get exposure to emerging markets. So I do notice it's very, very small, only about 0.5% of your entire exposure, and like 100% of your stocks, only 0.5% of it is to the XEC or emerging markets there. Though nothing to worry too much about it, because you're getting exposure to emerging markets actually through V equity and VGRO, which you have both of them in your portfolio. All in all, thanks for the opportunity, Joe. I wish you all the best and hope you are well on your path to getting to that retirement in the next 20 years as you envision there. And for that, you, my friend, as well, are getting a follow as well. I hope you all found this beneficial. As you know, in the past few posts as well that I post here, I've mentioned that if anybody is interested to get exposure to have their portfolio reviewed on my YouTube channel, you can simply comment on this post and any of those previous posts that I've had, and as a result of that, I will make sure I'll get to your portfolio in the subsequent video series and episodes. Thank you so much for this opportunity. If you haven't done that already, I would love it if you also support me by following and subscribing to my channel on YouTube. My YouTube channel is Momentum Finance, and I also will post quite frequently on Blossom Social. It's one of my favorite apps, and as you do notice that I have also a Blossom Pro account. I love it. I'm here to support the community, and hopefully we can learn together as we pursue our dream of getting to that level of financial independence, financial freedom, and the financial literacy and education that we all aspire to. Thank you so much, everyone, and I hope to see you all next time.